Investing in the right crypto at the right time takes luck, but more importantly, insights and precision. Only those who improve their investment methodologies every day, one mistake after another, consistently crush the masses. The best crypto trading tips come from years of practice investing in cryptocurrency markets. Fortunately, with this handy guide, any beginner can learn how to avoid common cryptocurrency mistakes and make the most of their money. Not reading, not diversifying, and not panicking are just some of the beginner mistakes every crypto trader should avoid. But before we begin, don't forget to subscribe to the channel and press the bell icon so you never miss another upload of the Future Millionaire. Having said that, let's jump right in. Number 1. You override. Some investors, mostly beginners, want to make 20 trades a day. This is dangerous. Ultimately, many of them lose from fees or because they make bad trades and then trade more to recover those losses. The reality is that there aren't 20 good trading opportunities in a day. Trading too much leads to poor decision making. Overtrading also increases your tax liabilities. Number 2. You chase cheap coins. Don't chase cheap coins with dreams of Lambos and private jets. Lots of uneducated investors in the crypto space buy low-priced cryptocurrencies because they think there is a higher chance of big returns. This is a common trap. There are lots of factors that affect a coin's price, including two important ones: the circulating supply and the real-world value of the coin. Number 3. You research poorly. The process will be time-consuming, but the more you research, the better you'll become at it. You can have a look at each coin's bitcointalk.org announcements thread and website. Check on the economics of the coin, such as its market cap, trading volume, price history, and total versus circulating supply. Cross-reference options from industry experts. Number 4. You don't use 2FA. One crucial step when working on your cryptocurrency investment strategy is to reinforce the security of your cryptocurrencies. Enabling 2FA on every sensitive website is the most important habit you need to adopt to increase the security of your accounts. Number 5. You don't own a hardware wallet. We will be straight up. If you've invested more than $500 in cryptocurrencies, then hardware wallets are a smart investment. They are disconnected from the internet, which means that hackers can only obtain your funds if they steal your physical device and also know the passphrase to access it. This makes security a much easier task. Number 6. You don't understand the market dynamics. Bitcoin only makes up about 50% of the market's liquidity. There are thousands of altcoins and they work in correlation with Bitcoin. Not understanding these correlations can lead to poor and costly investment decisions. Those who make money trading crypto understand these dynamics like the back of their hand. Number 7. You leave all your coins on exchanges. If you don't control your keys, then you don't control your coins. Exchanges are huge targets for hackers and are always at risk. When you leave coins on an exchange, you're trusting the exchange's security measures and not your own. Number 8. You fall for media propaganda. Major news sites will sometimes release very negative and often threatening news. Deceiving headlines are the foundation for propaganda. A lot of these news articles are intended to generate clicks, controversies, and sometimes even FUD. It's often very exaggerated. Number 9. You overly invest. Lots of investors are impatient and cut their losses early because of emotions. The cryptocurrency market is made of cycles where price rises and falls drastically. If you buy high, then you will need to wait out an entire new market cycle to end up with profits, meaning a new bear, then bull run, which can be well over a year of waiting. For that very reason, never ever risk the money you can't afford to lose. Number 10. You don't diversify your portfolio. While it may be tempting, don't put all your eggs in one basket. Every experienced investor hedges or protects his or her risk by investing in multiple assets. It's a good idea to own at least 5 cryptocurrencies. Well, that was what mistakes newbies make in crypto trading. Here are some bonus tips to what not to do. Maybe they will make you some good amount one day. Do you remember future millionaire that very day? Tip number 1. Have a strategy for crypto trading. It isn't easy to separate genuine cryptocurrency recommendations from the scams. There are lots of sharks out there waiting to take your money. In 2020, according to the UK Fraud Alert Service, Action Fraud, reports of crypto investment scams surged by 57% year-on-year to 5,581, with investors losing a total of 113 million euros. So when you're confronted with a lot of information about a cryptocurrency, take a step back from the hype. Try to look critically at the project. How many users does it have? What problem does it solve? Does it have any links with industry? Avoid coins that promise the earth but haven't delivered anything tangible. Number 2. Diversify your crypto portfolio. It doesn't pay to have too much invested in one single cryptocurrency. As with stocks and shares, spread your money out among different digital currencies. This means you don't risk being overexposed should one of them plummet in value, especially as the market prices of these investments are highly volatile. So do your research. Tip number 3. Use trading bots. Trading bots can be useful in some circumstances, but they don't come recommended for beginners looking for crypto investment tips. Often they're just scams in disguise. If real algorithm existed that timed your buy and sell trades to perfection, everyone would be using them. If real algorithm existed that timed your buy and sell trades to perfection, everyone would be using them. Before we dive into the last and the most important tip, have a look at our merchandise. Become a future millionaire now. The link is in the description below. Tip number 4. Be in it for the long term. Prices can rise and fall quite dramatically day to day, and novice traders are often duped into panic selling when prices are low. Cryptocurrencies aren't going to go away, and leaving your money in the market for months or years at a time could offer you the best rewards. With that, we come to the end of today's video. If you have anything to add or ask us, let us know in the comment section below. And join in next time for more of such interesting content. Goodbye.